This video gives a high-level description of financial wellness and benefits information and is in no way representative of the benefit that may be payable to any individual. AT&T does not provide investment, financial, legal, or tax advice. This video is intended to provide education on the AT&T benefit plans. Every person's financial situation and risk tolerance is different. You may wish to consult your personal tax advisor or financial planner prior to taking action. If you've taken advantage of the spillover election or after-tax contributions in your AT&T Retirement Savings Plan, you might have built up a substantial after-tax balance. There's a way to build potentially more tax-free income with Roth strategies. For a more strategic approach to your contributions or retirement income sources, consider converting your after-tax balance to Roth. Qualified Roth withdrawals are tax-free as long as you are at least age 59 and a half at the time of the withdrawal, and the Roth conversion occurred at least 5 years ago. If you leave the money as after-tax, you'll pay taxes on any earnings when you take a distribution. There's an annual 401k contribution limit for the total before tax, Roth, company match, and after-tax. Knowing the limits on before tax and Roth, you can separately project your match to estimate how much you can potentially contribute in after-tax contributions. When you convert after-tax to Roth in your 401k account, you convert your contributions, plus any earnings. It has to be prorated between contributions and earnings. You cannot convert contributions without the associated earnings. For example, if you contributed $5,000 to after-tax and acquired $500 in earnings, you can convert $5,500 to Roth in your 401k account. This is a taxable event for the earnings of $500. This will probably cost you about $120 in federal taxes, and if you're in a 24% tax bracket. State taxes may apply as well. Now you have an extra $5,500 in Roth that will grow tax-free and can be a tax-free income source for you in retirement. Historically, the ARSP usually has about $2 billion in after-tax money, over half of which is made up of earnings. Any earnings are fully taxable. If you perform a Roth conversion on a large after-tax balance, you'll be responsible for paying taxes on all of the earnings out of pocket, which could drastically impact your taxable income that year. Not sure if you have an after-tax balance? Log into netbenefits.com/ATT and choose Statements from the Quick Links menu to run a statement. Add your basic plus supplementary after-tax balances to find the total after-tax market value. Then scroll to Your Account Information and view the basis to find the total after-tax contributions. Your total after-tax market value, less your total after-tax contributions, is your total after-tax earnings. If you have a lot of after-tax earnings, you may wish to consider an alternative where you can take a general withdrawal of your after-tax balance and perform a direct rollover to a Roth IRA and a traditional IRA. Simultaneously, move the contributions to the Roth IRA, where they will grow tax-free, and move the earnings to a traditional IRA, where they grow tax-deferred. This could be a good strategy to avoid a high tax incidence in 1 year, but it may open you up to higher fees in an IRA compared to what you would otherwise pay in your 401k. Once you have cleared the deck and moved a large after-tax balance out of your 401k account, consider the in-plan approach in the future. You do have a choice. Do an in-plan conversion if you can handle paying extra in taxes to convert the earnings, or clear the deck with a 2 IRA approach. Before taking action, ensure you understand how a Roth conversion can impact your tax situation. Being aware of how much of your after-tax balance is comprised of earnings will allow you to approximate your tax liability. Interested in learning more or want to move forward with an in-plan Roth conversion? Call the Fidelity Service Center at 800-416-2363 and let them know you would like to explore converting your after-tax balance to Roth.